Hi, I'm Alex Vi.
I'm Edward Ding.
Hi, I'm Carl Worth.
Hi, I'm Paul McDougall.
And I'm Christian Moran. Welcome to our presentation on monetary policy during these unique times, not only domestically, but also globally. The US is experiencing substantial tribulations during this period of instability, with the coronavirus shocking markets in late Q1, leaving the economy reeling. The federal funds rate reflects this, with the current target at its lowest since 2015. With the option of raising rates clearly off the board, what must be addressed is whether the Federal Reserve should maintain its current target or test new waters and dip into negative interest rates. This answer is key to fulfilling the dual mandate and stimulating the economy into expansion. Next slide.
We recommend that the Fed maintains the current federal funds rate target range of 0 to 25 basis points. While there has been some recovery across large swaths of the economy, that recovery has stalled in the face of decreasing fiscal stimulus. Furthermore, the ongoing economic recovery has been unevenly distributed in its extent. Depending on income level and industry, certain consumers and firms are struggling far more than others.
We began our analysis examining broader indicators that may show trends in consumer and producer confidence. While many indicators appear to show improvement, these outcomes are hard to interpret given the sudden nature of the shutdown and the significant injection of fiscal stimulus that is reflected in many of our graphs. Next slide. Prior to the shutdown, our economy was in its 128th month of expansion, a record for the United States. However, the sudden shutdown resulted in a 31% plunge in real GDP in the second quarter. The economy was actually operating beyond its potential for the first time in early 2018 since the 2008 recession, which could potentially have led to some of the first real inflationary pressure we would have seen during this expansion. Given that GDP data is not as readily available as some of our other metrics, we may see some increases in quarter three that match with the recovery we are seeing across other indicators, but that remains to be seen. Next slide.
COVID hospitalizations remain dangerously high as we enter late fall and winter. This will be especially bad as activities move indoors and flu season begins. We have seen a trend wherein an uptick in output is correlated with an uptick in COVID cases, implying an economic recovery is constrained by the virus. Next slide.
While the stimulus package in March paid dividends in jump-starting economic recovery in output markets, this graph shows us that for the unemployed, maintaining high consumption largely relied on additional unemployment insurance. Once those benefits expired, spending among the unemployed fell tremendously. The size of the March stimulus package is reflected when comparing federal debt to GDP, which has spiked in 2020, even when compared to the whole course of the Great Recession. Policymakers may be hesitant to sign off on additional fiscal stimulus, given how high this number is getting, another example of the uncertainty the Fed is facing during the pandemic.
Since the 2008 recession, non-food and energy PCE inflation has remained under or just around the Fed's 2% target, giving us confidence that continued expansionary monetary policy will not let inflation run loose. The beginning of the shutdown saw a rather significant decrease in the inflation rate, but it has since rebounded to approximately pre-shutdown levels. And now Christian can speak on the outlook of inflation in the coming years.
Thanks, Carl. In addition, the sharp rebound in the break-even 5-year indicates that the economy is being adversely affected by transitory factors. While the interest rate is still below the target of 2%, this fast recovery illustrates that market participants' confidence in the economy and its ability to rebound after the vaccine is distributed is still high. Next slide.
The drop in consumer sentiment and the spike in personal saving rate both reflect public underconfidence and anxiety, both linked to the pandemic situation. One point of interest here is that while consumer sentiment has yet to recover significantly, the saving rate has already begun to drop to pre-pandemic levels. However, the change in savings does not necessarily indicate growing confidence, given that many consumers have found it necessary to dip into their savings for paying bills. Next slide.
In nearly all the preceding recessions going back to the 1960s, a recession has actually been preceded by a drop in housing starts. This is not the case currently, as housing starts were on the rise prior to the shutdown. While they dipped in its initial stages, they are already back to pre-shutdown levels. This increase makes sense, given the simultaneous increase in homeownership we are currently experiencing. Similarly, in the previous two recessions, mortgage rates did spike at some points, indicating lender uncertainty. This has not been the case thus far, as mortgage rates continue to fall, buoying this surge in housing demand that we've seen over the last few months. Overall, both these indicators appear very different than they did in 2008, lending further credence to the notion that this recession is more of a natural disaster, as Chairman Jerome Powell put it recently, rather than a more cyclical recession driven by purely economic factors. Next slide.
One area of stability has been the Producer Price Index. As depicted, the PPI only experienced a small initial decrease and is now recovering. Its past quarter revealed that the services sector led the PPI in exceeding expectations and showed that the cost of services increased solidly and is at a healthy level. On a broader level, it exhibited that underlying producer inflation continues to hold firm. Now Edward will speak to the Purchasing Managers Index.
Thank you, Christian. So the Purchasing Managers Index, as implied by its name, focuses on purchasing managers of manufacturing firms, specifically on their confidence in the economy and in supply chains. Though the PMI saw a sharp drop at the beginning of the pandemic, it has risen past pre-COVID levels since. Next slide.
We see here that from April to July, there has been some recovery in new orders for durable goods, a metric that indicates firms' expected consumer demand in the near term. However, from the most recent data in August, durable goods orders increased by less than a percentage point. This flatlining could be in anticipation of consumers running out of fiscal stimulus in conjunction with continued weakness in the labor market, which we will now talk about.
The current trends in unemployment differ from those during the Great Recession, when unemployment slowly increased from 5 to 10%. During the March to April shutdown, unemployment shot from around 4% to nearly 15%. Since then, unemployment has fallen substantially, though the return to full labor capacity has recently slowed. U6 has begun to converge with U3 as the unemployed have gotten some hours back. Next slide.
A sharp decline in labor participation further indicates the faltering state of input markets. While labor participation has been falling gradually since 2000, at the onset of the pandemic, it fell 3 percentage points before recovering around half of that. Since there is no precedent for this much of the labor force leaving at one time, even a return to a natural level of unemployment may not be indicative of a complete recovery of labor markets.
At the outset of the 2000s, real wages were effectively the same as they were in 1960, indicating limited wage growth over that span. Since then, wages have seen moderate gains, but the large spike you're seeing at the right of the graph on the left is not necessarily wage gains. That recent spike is due to low earners, disproportionately service and retail workers, losing their jobs or being furloughed as a result of the shutdown. The Department of Labor reports that 35% of the lowest earning workers in the United States lost their jobs, compared with just 9% of the highest earning fifth, as illustrated on the image on the right provided by the Washington Post. Wages are intrinsically tied to fiscal stimulus and transfer payments. So this is very much a wait and see indicator. Next slide.
Now we'll be discussing some trends we've seen in financial markets. Next slide. In the aftermath of the last two crises, the Fed has taken serious monetary measures unseen in previous recessions. The balance sheet has swollen to about 30% of GDP, with this comprising primarily of treasuries, mortgage-backed securities, and corporate bonds. This leaves the question as to how much monetary ammunition the Fed has moving forward. Next slide.
Since the beginning of the pandemic, Treasury yields have plummeted to unprecedented low levels. Massive investor uncertainty has led to a flight from riskier markets to Treasury bonds, which has been the main driver behind the yield drop. 2-year yields have decreased even more dramatically than 10-year yields, largely due to the lessened inflation risk associated with shorter-term bonds. Next slide.
Despite the surge in M2 due to expansionary monetary and fiscal policy, inflation has stayed muted, in part because the velocity of money has been very low. This lends credence to the idea that rates can stay low in the foreseeable future without overheating the economy and generating rampant inflation. Next slide.
The decrease in the BAA shows that investors no longer need increased compensation for default risk. This holds for both lower and higher grade investments, as the AAA spread shows a similar trend. While the spread is still at a relatively high rate, it is not at an unprecedented point and is similar to previous levels when the economy was experiencing stable periods of growth. Edward will now speak to the TED spread.
Thank you, Christian. So the TED spread measuring credit risk saw a brief spike at the start of the pandemic, but has at this point returned to normal levels. Spike was much smaller compared to the one seen in 2008. This is indicative of how the COVID recession was unlike the 2008 recession, not due to a fundamental financial failure, thus there's been much less fear of bank default. Next slide.
Now we will be discussing the bifurcation in the economic recovery, wherein certain industries like information technology have remained strong and others have struggled tremendously. Additionally, the recession has afflicted the most vulnerable in our society much more than it has affected those who are well off. Next slide.
Regarding retail and restaurant sales, though both fell at the start of the pandemic, restaurants have and continue to suffer to a much greater extent. This can be attributed to the nationwide social distancing restrictions. While retail includes online retail, which has surged during the pandemic, restaurants are more or less dependent on in-person service. I just mentioned online retail, and it's important to note that traditional brick and mortar retail has suffered just as much as restaurants, something that is not captured by this general retail graph. Next slide.
In contrast to residential real estate and online retail, tourism is another example of an industry that has been hit hard by the pandemic. Whereas usually there's a seasonal uptick of hotel stayers and commercial plane passengers come summertime, here we see both hotel prices and commercial flight miles have plummeted. An interest rate hike could be devastating to industries like these that have very high fixed costs, potentially resulting in firms having more layoffs or even ceasing operations.
Looking at the federal funds rate's recent history, it never went below 0%, even during the Great Recession. While Ben Bernanke cites negative interest rates as potentially having modest benefits and manageable costs, at the same time, they should only be used as a final limited ammunition of monetary policy. Neely argues that commercial banks would face reduced profitability, which may bring about unanticipated consequences. According to Bettini and Nelson of the Bank of England, monetary policy doesn't bring about its full effects until at least a year after it is enacted. Therefore, we do not recommend a negative interest rate policy at this time. Next slide.
To conclude our presentation, we once again implore the Federal Reserve to consider maintaining the federal funds rate at its current 0 to 25 basis point bound, along with holding steady on other rates, including the overnight reverse repurchase agreement, interest on reserves, and the primary credit rate. An increase in those rates amid such uncertainty and delicate growth could stifle the progress we have made thus far. Additionally, the ambiguity surrounding future fiscal policy due to the upcoming presidential election only further amplifies our call for stability. While the sudden downturn of the economy caused by the shutdown may invoke some to consider negative interest rates, we feel that there is too much successful precedent to the 0 to 25 basis point bound to recommend that the Federal Reserve do anything else except maintain the current rates. Right now, we are in the midst of an economic contraction like no other before. Businesses were forced to close and people were ordered to stay home. In the months to come, as much control as we would like to exert over the economy, we must accept that COVID-19 is in the driver's seat. And until it relinquishes that control, we recommend that the Fed do everything it can to uphold the dual mandate by projecting stability. Thank you for listening to our presentation, and stay safe.